Welcome to my video. There's a lot of confusion as to the raising of rates. That's all we hear, how the rates are going to go up because the economy is doing so well, and that is not the truth. I'm going to explain to you how these rates affect you and me, and you'll have an understanding of these rates. First of all, let's talk about the rates. What rate are they talking about? Well, they're talking about the Fed rate. That's the Fed rate. Okay, now the Fed rate, okay, is the rate that right now, if you look at the interest rate on the Fed, it's 0.013. Now that rate really is zero. Okay, that's what is zero. No question about it. Everybody talks about the zero rate. Now the zero rate, this is the rate at which the Federal Reserve loans to your bank, which loans to what? Well, it loans to your business, number one, okay? It affects your credit cards, it affects your adjustable rate mortgage, and affects the rate at which they loan to businesses. So the 10-year rate or yield, okay, as they call it all the time, remember that yield is very important because it affects, again, credit cards, adjustable rate mortgages, and the money lent to businesses. They haven't changed that rate for 64 months. The reason they can't change that rate because the economy is not good enough, okay, to raise rates on credit cards, adjustable rate mortgages, and businesses. Therefore, if the economy was so good, wouldn't they be raising these rates? No. We were told the other day, we were told that they were going to start raising rates in June. Do you remember that? Okay. But first, before I go on, then there's the other interest rate, which is the 10-year, and that's the 10-year Treasury, okay, 10-year Treasury rate. What is that? That's different than the Fed. The 10-year Treasury, that's very important because the 10-year Treasury is or affects your 30-year fixed rate mortgage, what your loan's going to be, what's the interest rate, and it affects auto loans, okay? It also affects the big thing, the interest rate at which the government is charged on the money they borrow. Right now, they never want to pay more than 1.5%. Right now, it's 2.2%. That's very high. That's a real problem for the government. So are they going to raise these Fed rates with the economy the way it is? Are they going to raise rates on your credit cards, as I said? Of course not. They can't do that. It makes absolutely no sense at all. And if you remember, Yellen said that she was going to do it in June. Now, let's talk about that for a minute. So the dollar, we'll put it in green over here, the dollar since last June for a year now has been going up. That's the dollar. And when the dollar, why is the dollar going up? Because the 10-year rate continues to go up. When the 10-year rate goes up, when the 10-year rate here, let's use the 10-year here in white. When the 10-year rate goes up, okay, 10-year rate goes up on the Treasury, that moves up the dollar, okay? So the dollar goes up. Why is that? Because Europeans, put them over here, okay, we put them over here. Europeans, what the Europeans do is the Europeans dump their euro, okay? They dump their euro, and what do they buy? They go over and buy the dollar. Why do they buy the dollar? Because the dollar is going up because they feel they want to own the dollar because the 10-year interest rate is going up, which reflects that the economy is doing well. Let me repeat that. Anytime the 10-year Treasury yield or interest rate goes up, the Europeans sell the euro and they buy dollars because that means the Europeans, anytime the 10-year yield or interest rate goes up, the economy is really doing well. Therefore, they want to buy dollars. Okay, they're going to buy dollars. Why would they stay in euros? Because when the 10-year yield goes up, it also brings up the dollar, so they invest in dollars. At the same time, the stock market goes up. Okay, at the same time, the stock market goes up. So let's think about this. So since last June, the 10-year Treasury's been going up because they're saying they're going to raise rates on the Fed rate. So when you raise rates on the Fed rate, it automatically moves up the 10-year Treasury. which of course is making everything more expensive. But on the other hand, the stock market or the dollar goes up. Here's the dollar, and the stock market goes up. So what you got going up on this lie that started a year ago, that the economy is so good that we're going to raise rates in June, that everybody dumped the euro, and for the last year the dollar went straight up because the 10-year treasury went up, the dollar went up, and the stock market goes up. Now, what was happening is, while they're going up, gold went down. Gold and oil prices went down, okay? Now, the problem is when the dollar goes up, that's killing all the companies that are the big multinational companies like IBM, Coca-Cola, American Express, Intel, Microsoft, all of them. They all get killed because when the dollar goes up, they can't compete overseas. They can't compete. So that is hurt. That's starting to hurt the stock market. And that is what has happened. Remember, all the multinational companies started to fall. Well, now that we started everybody is all excited and everybody decided, well, this is great. The economy is doing terrific because Yellen said we're going to raise the Fed rate in June. Well, as we got close to June, they started to figure out it wasn't true. And we had all this terrible economic numbers coming in, awful economic numbers. I mean, it was the worst, but nobody cared. Nobody cared about the economic numbers. No one cared at all. What did they care? Because as long as the dollar was going up, nobody paid attention to the factory orders were falling for the 6th straight month or for 7 straight months in a row. Nobody cared that the U.S. customers or consumers, the bankruptcies just experienced their largest quarterly increase in 3 years. Nobody cared about that. Nobody cared about the wholesale prices had the biggest plunge since 2009, or as I say, factory orders fell for 7 months in a row. Nobody cared that household spending went to its lowest level since 2008. Nobody cared that retail sales dropped to its lowest level in 9 years. Disposable income dropped the lowest in 40 years. Wages dropped the lowest in 30 years. Home ownership dropped the lowest in 25 years. Durable goods dropped the lowest in 6 months. And the U.S. trade deficit widened to its highest level since 2012. Nobody cared. Why? Because Yellen kept coming out and saying what? That she's going to raise the Fed rate up here. She's going to raise this Fed rate up here in June. And that rumor is supposed to be June 2014. So based on that, starting in June of 2013, the dollar starts going up because euros were dropped and the Europeans bought the dollar, and the higher and as long as they know the Fed rate's going up, remember, higher Fed rate brings up the 10-year treasury. So everybody was happy. Now they found out about 2 months ago that things weren't so good and the stock market started to drop. Okay, I'm sorry, the stock market over here started to drop. Here's the stock market. Sorry about that. Stock market started to drop over here. Okay, and then all of a sudden, last week, the stock market started to drop, and the dollar started to drop. They both were dropping. Then last week, what happened? The dollar gapped up right up here. The dollar started to go up again. Why? Because they said, "Oh, we're going to have interest rates going up again. We know the economy's good. Look at the housing. They came out with 1.1 million in housing starts, and they're all excited about it. And the same day last week, they talked about Europe did more quantitative easing. So on the quantitative easing, on the 1.1 million in housing starts, everybody announced the economy is doing good, and she is going to start raising rates again. Okay, and she was going to raise rates in June. Well, she came out later and said she wasn't going to raise rates in June, and then the dollar, guess what happened? All of a sudden, the dollar started to come back down. And then the next day, they came out and said, well, we're going to start raising rates in July. And then the dollar went back up the next day. So we got this volatility between the dollar going down, the dollar going up on every little bit of information based on this rate going up on the Fed. They can't raise the rate on the Fed. It's impossible. It's not going to happen. Okay? It won't happen. Because first of all, to raise rates on that Fed would kill, okay, as I said, it would kill this economy. No question about it. It would really kill the economy because remember, there is no way with the amount of jobs we have right now and what they've been doing to raise this, the other thing they've been doing to raise this dollar. In other words, high interest rates make the Europeans excited. High interest rates is a signal to Europe that our economy is good. And that is why Yellen keeps saying our economy is good. But what they keep pointing to keep raising this dollar and raising this 10-year treasury is the amount of jobs we create. But we know the jobs that they're creating are terrible. The jobs are just all part-time jobs. So what's going to happen here? What's the truth of all this? Here's the truth of it all. Here's what's going to happen. The stock market now has halted. The stock market is going up like this, and the stock market has halted. It's in this it can't break out. Why can't it break out? Because that 10-year treasury keeps going up. The interest rates keep going up. 1.1, 1.9, 2 points, 2.1, 2.2, and these interest rates are a killer. Okay, the interest rates are a killer. So with high interest rates, the stock market doesn't go up. The stock market instead starts to go down. So what they've been doing, the stock market's been going in this range right in here. It's been staying right in this range right in here. It's having a hard time breaking out. So what they got to do is this is the rate at which the government pays interest. Government can't pay that kind of interest. So how are they going to get this interest rate down? Well, there's the main way of they getting the interest rate down is the Fed comes in, they bring in their printing machine, they print dollars, and then the Fed takes those dollars and goes in and buys all these rates. And when they buy these treasuries, what happens is the yields come down. And when the yields start dropping, the rate at which the government's borrowing money, they have to bring that rate down. The yield comes down, and the stock market then will continue on its way. It'll break out and run. But you got to get these yields down. The only way you can get the yields down is by getting the printing machine out and by printing money and buying all these yields. That way, when China comes in and the Saudis come in, they normally buy these. Instead of buying these, they go over here and they buy the stock market because they don't want to buy at 1.1 or 1.2. They don't mind buying at 2.2 or 2.1, but when the Chinese and Saudis transfer their money to dollars, okay, they usually will loan the money to the Treasury, okay, at 2.2, 2.1, and they're happy. But when they come in and they see these rates are down here, and how they get down? Well, Yellen made sure she bought all of these, so to make sure she brings it down to make these rates unattractive so that these guys will come into the stock market and break the stock market out. This is why we're going to have QE4, okay, QE4. And what's going to happen? Because the interest rates are climbing, the stock market is going to keep breaking down. It's going to turn around and go down. The stock market is going to keep going down because the market does not like high interest rates. It's like Krypton. Okay, it's Superman. So at some point they got to get these rates down to push this market back up, and that's where we are right now. We're struggling to get up because the yields are too high, and they got to get these yields down. The only way to get the yields down is to get Chinese for the printing to buy all the treasuries to bring the rate back down under 2%. So China and Saudis don't buy treasuries, don't loan money to government, but instead buy the stock market. So what's going to happen? We're going to get probably about a 10% correction in the stock market between now and the fall. And then this fall, when we buy oil, here's the problem. Every time, remember, the dollar goes up, our oil, every time the yields go up, and every time the dollar goes up, okay, that kills our oil. Our oil prices go down, okay, oil goes down. So the problem we have right now, our oil prices are dropping because, again, when a 10-year treasury goes up, okay, the dollar ends up going up. And when the dollar goes up, it brings down oil. And the problem with oil coming down, we lose more and more jobs. 40% of our jobs come from the oil field. So we got so much going against raising the 10-year treasury from where they loan money to your bank, and your bank loans money, as I said, to your banks overnight, so they can loan money on your adjustable rate mortgages, loan money to your business, your credit cards, all that stuff. Not going to happen. So here's what's going to happen. We're going to get a correction so we can move this market up, and they're going to have to do that by bringing in QE4. There's no question QE4 is going to happen. Because why? Because oil. Because what's going to happen is we have to import all this oil now. See, we got to bring all the oil over from Europe. And when we bring all the oil from Europe, we don't have any money to pay for it. So we're going to have to borrow money to pay for the oil. And that means the interest rates are going to go up even higher. So now we'll be up over 3.1%. That'll kill the United States government when they're borrowing money. So because all this oil has to be, because we cut all the fracking and because of all the environmental issues, we cut the production of oil, we're going to have to bring oil in from Europe. So when we bring this oil in from overseas, right? Okay, from the Saudis and Europe and whatever, we got to pay for it. And we don't have the money to pay for it, and it's too expensive. So they're going to bring QE in to drop this rate down so that the government can borrow money at 1.1% to pay for the oil we're bringing in. So this fall is going to be critical. When the weather turns cold, we got to bring all this oil in, and they're going to have to bring the yield down, the interest rates down. That's why they're going to do QE4 to pay for the oil. So don't listen anymore to what Yellen says or CNB says or anyone says that the interest rates are going up. They're not going to go up. So this way, you can always play the dollar, what you need. Okay, for example, every time the dollar, and we've been doing this, every time the dollar, if you look at the dollar over here and you bring it back, and you bring the dollar back to last year, see this dollar going up? And then you notice how the dollar dropped when they found out Yellen was lying. The economy's not doing well. She's not going to raise rates. And then last week, right here, the dollar jumped up again because of the housing starts, which is a bunch of baloney. The housing starts, we had bad weather in January, February, March. So April came out. Of course, you're going to have a surge in house building. But that's going to be leveled off at $825,000 a month. The dollar will drop back down. Right now, they're trying to pump the dollar up. And when you pump the dollar up, what happens to your stocks? All your oil stocks go down, right? So here's oil. See, the oil started to drop the other day. All your oil services started to drop the other day. You see? All your oil services started to drop every day. And when your oil prices go down, it's killing the economy because no private money goes in there, and therefore we get 40% of all our employment comes from the oil sector. So oil prices going down, we don't get private investment, we lose jobs. So you see, no matter what we see going on, okay, interest rates aren't going up. So they're going to have to do QE4. And bottom line, just remember, when the dollar goes up, your oil and oil services and all the big companies, when the dollar goes up, IBM, Microsoft, Johnson & Johnson, Apple, they all get hurt too overseas. So they're going to have to change this, okay, and soon. So again, no more interest rate talk. It's a bunch of nonsense. In the meantime, we'll be on the right side of the trade, okay? All right, we'll see you on the charts.